So this is Maxime and I's 10-year investment plan. Coming up with an economic forecast was a bit challenging just because of how uncertain everyone is and how volatile the markets are right now due to COVID. But currently the indexes are up from their lows in March, and they're starting to return to where they were middle to end of last year, which is a good sign because in February they were at an all-time high, which hopefully in the near to mid future they will start to return to that. Looking at the markets, they're not efficient, so we tried to pick funds that we could actively manage as opposed to index funds, just things that we can have more control of if they aren't going well and whatnot. U.S. trade right now is down $44 billion. So we try to get into markets that are still active and have a very productive future and kind of have a plan for the future. When we go into like our stocks and whatnot, we focused on semiconductors, which is a huge industry right now and is a big part of the AI development, which is going to drive science and other studies into the future. Looking at fair value and current value, it's kind of hard to predict just because a lot of stocks lost a big portion of their value when the crash happened in March. So we just kind of tried to look at historical data and then look at the progress that the bonds, stocks, and funds have made since the crash in March.
Next up are our objectives. The goal is to reach $300,000 10 years from now, starting with $100,000 right now. And in order for us to do that, we'll need an average annual return of around 11%. So that's what we will be aiming for.
The short-term stock that I chose was Intel. Intel's shown really good growth over the past 2 years and historically has been a pretty strong stock. The PE ratio for Intel is 10.78, which is in a good range for that industry. Looking at currently how it's kind of rebounded from the initial loss that it had from coronavirus, it's already back up to $58, and its 52-week high was just over $69. So this kind of gives us hope that it's starting to return. It was much lower than where it currently is in March, so it started to rebound, which is a good sign long term that Intel will continue to drive. It has a quick ratio of 1.01, which puts it in a good area for an investment, and they're one of the leading developers in AI and consumer and enterprise computing. So as the world starts to kind of rebound and businesses are needing to stay up to date on their technology, Intel is going to continue to produce products that these companies and businesses need.
The stock that I chose is IBM. First up, some ratios. Its PE ratio is 8.43, which is below the industry average, which means it's undervalued. Its price to book is 4.61, which is right around the average of the industry, which would mean it's fairly priced. But then the price to free cash flow over share ratio is 6.53, and that yet again is below the industry average, which would mean it is undervalued. By calculating the fair value using the dividend growth model, price to earnings, and price to sales, the average is $130. It's currently trading for $122, so that means it would be undervalued right now. The future of IBM is definitely in AI and its cloud services, which is a growing sector within IBM, but also within the world. So that is pretty good for IBM. And we would already have a 6.3% return if the price goes to the fair value. But with a bright future in AI and cloud services, we expect IBM to grow up to $240 over the next 10 years. And this would net us with a 7% annual growth. Now, this is 4% under the 11% that we need to reach our goal, but IBM will only be a 10% in our portfolio, so we have enough space to make up for that.
For a bond, I chose Sprint. It has a Moody's rating of B1, which isn't all the way at the top, but it still puts it in a good investment range. The debt to equity ratio is 1.73, which is a little higher than we wanted. But since the bonds aren't a huge part of our portfolio, we weren't too worried about that. It has a coupon rate of 7.25%. And because of where interest rates are at, there's a chance that it could be called. But we can't really predict that. That has an 8-year maturity.
Then the bond that I chose is Netflix. In general, bonds will not be that important in our portfolio just because bonds in general are not very risky, and we're trying to have risky investments because we have a high risk tolerance. But we still chose a bond with some risk. It's rated A3 by Moody's. It has a debt to equity ratio of 1.74, and it is a callable bond with a maturity date of 2028, so within a 10-year period. It has a coupon rate of 4.875% and a yield to maturity of 3.939%. So again, that's well below the 11% that we're looking for, but bonds will end up only be 2% of our portfolio, so it doesn't really matter. One thing to note, though, is that if interest rates drop too much, Netflix does have the option to call the bonds because they'll be able to finance their operations for lower interest rates. Then the fund that I chose is the Columbia Small Cap Growth Fund. It has an average return of 12.79% in the past 10 years, which is 10.2% higher than its competitors. It does have a standard deviation of 23.77, a Sharpe ratio of 0.68, and a Sortino ratio of 0.58. Now, these numbers all indicate that this is a very risky fund to invest in, but it also has some great returns, and high risk, high reward is what we're looking for because we have a high tolerance for risk. So these numbers do not scare us. The portfolio consists of mostly US equity, about 97%, and the biggest part of the remaining 3% is held in cash. It has a high exposure in technology and healthcare. And just like our own stocks and bonds, we do think technology is the way to go in the future. So that's why we like this fund a lot, actually. Then it has a front load fee of 5.75%, which is a little above the average for the category, but we'll end up spending about $65,000 of our $100,000 capital on this fund, and 5.75% of that would be between $3,000 and $4,000, which might look like a lot, but if we end up with $300,000, that'll only be around 1%. So we're actually really happy with that fee.
For my fund, I chose Vanguard Mort. It's been pretty strong through the coronavirus. It has a 52-week low of $20.84 and a yearly high of $21.89, and it's currently sitting at $21.85. So it's only 4 cents under the 52-week high, which is a pretty strong place to sit considering its low was a little over a month ago. So looking at it as a long-term investment, it's already rebounded from a pretty substantial crash in the majority of the markets and funds. So we're predicting that this will hold on pretty strong. It is a turnover ratio of 190% and a standard deviation of 0.04. And then looking at the Sharpe ratio, it's got a ratio of 1.21 over 10 years. And for our asset allocation, it's going to be towards the top, not as tall as the Columbia Small Cap Growth Fund. that Maxime talked about, but it's going to take up about 15% of our overall portfolio. So it's a little bit safer and doesn't have as big of a return, but it's more of a safety net in case our Columbia Small Cap Growth Fund doesn't do as well.
And then our asset allocation. So in order for us to attain our 11% annual return, we will allocate our funds as follows. It'll be 65% in the Columbia Small Cap Growth Fund, 15% in the Vanguard Mortgage-Backed Securities Fund, 10% in IBM stock, 8% in the Intel stock, and only 2% into bonds. Then for our conclusion, we have a high risk tolerance, which means that we have we're trying to get high risk investments. That's why we have a 65% into our small cap growth fund. During economic downturn, we probably will move our assets from our small cap growth fund into the safer mortgage-backed securities fund to hedge against our losses. And in extreme cases, there is always the option to move our assets into more investment-graded bonds. But the small cap growth fund has been around since 1996, and it's currently in its third recession, but it still has an average annual return of 11%. So we might not have to move our money after all. Thank you.